right, so we just barely pulled in. Unfortunately, in Utah here, we're getting a lot of smoke coming over from the fires on the west coast. Did not see that necessarily in southwest Colorado, except for one day. But that was one of the most beautiful spots of the country I've ever been in. Ouray and Silverton, Colorado, as well as Durango. Highly recommend it. But we just barely pulled in. The market just literally hasn't done anything since I've been back. But there is some shifts. There's some pretty significant shifts going on. I know everyone's kind of been, how bullish are we? And, will it be a 5% pullback? Will it be a 10% pullback? And it's like the market doesn't care about your 5%, 10% numbers. It cares about, the pullbacks in terms of the bullish moves that we've had. And we've had a heck of a bullish move. So does that mean we have to have a big one? Do we have to drop now? Can we just keep grinding? That all depends on what's going on, what's underlying here from an asset class and sector standpoint. So we're going to take a look at those big shifts, big moves in the last couple of days that can kind of give us some clues. So we're going to break those down. And our trade idea of the day is actually on a stock that's having its own little bullish breakout here. But the question is, how bullish can we be? And so similar to other trade examples that we've done in these videos, we'll talk about how we can trade that, get some positive deltas without being aggressively bullish. So let's go ahead and get started. Today is Monday, August the 9th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. So the last couple of days here, out of town on Friday and then today, leaving after Thursday, so really hasn't done much of anything. A little up and a little back down, and the intermediate posture still bullish, the long-term market sentiment still bullish, the near-term line still strongly bullish. So you still have all three lines up there. You have the momentum line showing you a oversold reading, a little bit below 20, but not extremely, not below that dotted line. So that's a bullish signal, oversold momentum. Again, we saw that over here. It was a little bit more oversold, but it still never did get below that level. Had the near-term line down there too, and we bounced off of that on this current near-term rally. So the question is whether we'll bounce off of this and continue this near-term rally, heading into, going into next week, which will be August expiration. So kind of like, not like last expiration cycle. We did have a little bit of a dip, but not enough to bring the near-term line down. But the near-term cycle before that, we did. Kind of in the middle of the cycle, we had a little near-term dip. But then we rallied most of the cycle there, rallied most of the cycle here, and currently rallying most of the cycle now. We dropped heading into expiration. We dropped heading into expiration there. Over here, we dropped a little bit before expiration. We're starting to bounce up off of that. But you can kind of see here we dropped going into and out of expiration. We rallied the rest of that expiration cycle. So that's what's going on right now on the S&P 500, just maintaining a grind. I mean, that's about as much of a grind. I mean, it's bullish. It's a higher highs, but that's about as much of a grind as as you're going to get. That's what a grind looks like. Very, very small moves, up to new highs, however, but very small moves, and that's kind of what you expect will continue to be the case as long as we maintain both a strong bullish intermediate posture as well as long-term market sentiment. You can see the Dow Jones Industrial Average looks similar, though its market sentiment line not quite so bullish and starting to roll over. We've been a little bit more sideways since that cluster on the Dow Jones. We've been, you can see we had an intermediate pullback there below 40 in the intermediate line, and then we've been unable to really get going off of that low point. The NASDAQ also, got a cluster here last week. Has been grinding ever since. You can see a bullish day on Thursday before I left, and then nothing the last couple of days. The near-term line coming down from that cluster. Still, though, strong bullish posture, strong long-term market sentiment. The Russell 2000s had an interesting couple of days. So, a good bullish day on Thursday, and then yesterday and Friday and today, kind of hanging around that moving average. In fact, yesterday closing above the moving average, getting us to light green shading in the yellow line pattern for the first time. Again, that's a bearish pattern, similar to what like a light pink shading and yellow line pattern would be for on the bullish side, right? So that would be the bearish side of it, and we'll see if that ends up playing out to being something more. You can see the near-term line dropped to the 5th percentile, but didn't go below. We've had a few of these here, so that's not, and we've bounced off of all of them. We are the near-term line did get up into the reversal zone for the a good strong level, well up into the 90th percentile, above the 90th percentile, pulling back down today. Market sentiment still falling and hitting, using 60 as some resistance here in the neutral zone this entire time. Even your intermediate line still in the neutral zone. So right now, both those levels are in the neutral zone and unable to really get going because we're unable to get a really good near-term rally going. In fact, we had a little bit of a divergence going there. We hit the low point in between the lows for a target on that near-term pullback. We've been bouncing up, but again, these long upper shadows have been holding for resistance, especially this one here. That long upper shadow holding for resistance. The top of that shadow, remember, holds as a resistance level on a closing basis, and so far that's been the case. And then today dropping back down below that moving average. Let's take a look at some of these other charts. You can see the again strong bullish trend, good bullish candles here. So we're not anywhere near. In fact, the Russell 2000 we're back below the 50-day moving average, but we're getting kind of bullish, very, very small bodies, but we're not getting bearish candles anymore and relatively bullish there. You can see the NASDAQ looking very similar and the Dow looking very similar to the S&P. Very bullish patterns. 3 green arrows again on the S&P 500, though that MACD is pretty much flirting between red and green. You can see why. It's not really going much of anywhere, and it's sitting right around this moving average. So you're going to continue to flirt until we can really break out. But you see, we're not in breakout mode. The MACD has peaked, and we're converging now. Just like over here, we peaked and we converged. We never did really break hard, though the NASDAQ did here, start its own intermediate pullback. But we've been converging ever since, and we're converging right now. The MACD peaked over here. We've been converging, still above the 8-day moving average, but converging ever since. You can see the Qs doing the same thing, the diamonds doing the same thing, though the diamonds did flirt with the 17-day moving average last week, but still sitting right around that. We're converging. We peaked, and we're converging ever since. IWM, you can see the histogram did roll up going into yesterday, Thursday, and then Friday, and then today bouncing back down, the histogram rolling back over. The MACD is just barely positive, as the 8 days just barely above the 17-day. Now, we didn't break the 17 and the 30 at the same time. We broke them in successive days. So now that's what leads to the type of pattern that you can get, right? If you go back, to the bullish side of things. Back over here, you can see we broke the 17, we broke the 17. We didn't break the 17 and the 30 at the same time. We broke the 17 and then the 30. That gave you the dark pink, the light pink shading yellow line, and that set the low point we bounced. So it's the same thing here. We didn't break the 17 and the 30 at the same time. We broke the 17 and then the 30 the next day. So now we'll see if we roll over in that histogram and the stochastics, which you can see is converging for a while now too, rolls over. So that some convergence showing up. You can see the convergence showing up here too, how we're grinding with lower highs. We're getting slightly lower high, or slight bearish divergence on the CCI. The CCI finally did get above 100. In fact, for 2 days now, I got above 100 on the Russell. But you notice we're just barely above 50, and we're already moving back. So really, really important that we hold that 50 level and we don't break back down below 0, right? Like if we do, we want it to be very, very temporary if we are indeed going to maintain a new bullish trend. The directional movement index here suggests probably not going, probably suggests we're not going to get that. You can see the trend right now for SPY is extremely low, both lines between 20 and 25. The ADX now is below 10. That is an extremely low ADX. That sets us up for a big directional move to come out of, somewhere. And the question is, which way? We're on a 9-month-long bullish intermediate run. What kind of bullish directional move can we get out of this, right? That's the interesting thing that SPY is telling us. IWM, you can see the intermediate, the ADX, has dropped back below 20. As your ADX, as the negative indicator stayed below 25. The positive has been using 25 as a resistance, so we'll see if it rolls over or breaks back above that 25 level or not. The Bollinger Bands, obviously we're at the top of the bandwidth still, flirting with the upper quartile, so pretty bullish at the top end of the value area. IWM broke through the upper half of the bandwidth, but still unable to get to the upper quartile. So, and you can't get above that point of control. We've really got to break out if we're going to get through that point of control, and most likely going to break out with some kind of breakaway gap that we're just not seeing, right? Even every time we get a little bit of a gap here, we fill it in, right? We gap up, we fill it in. That gap still hasn't filled in from back here, and that's hardly anything but a common gap. So very, very likely that we'll flirt with this 438 level by the time all is said and done here. Like probably by the end of this week, we'll probably flirt with that 438. Again, that's hardly bearish. It's only 4 points away. You can see very, very top heavy as we're really ranging sideways on SPY. If you see IWM, same thing. We still got that divergent or that gap that we haven't filled in over there, and that's a pretty common gap. All these other gaps have been, even today's gap, mostly filled in, and then we're very top heavy here. So you can see kind of where we might be able to trend down even to get to 217. Now, if we break 217, 218, that's the concern for IWM, because now that puts, because we've been so sideways and we're not getting new highs. In fact, when this high comes off the table, you'll have one more day where that will be the high point. And then the high is going to be from yesterday, from that open over there when we touched 225.21. So your high is going to really move sharply. But then in another week, your low is going to move up too. And it's really going to tighten up unless we get a new high or new low. And again, you've got significant resistance above you on the daily chart, which means the path of least resistance is down here. So that's something to keep an eye on in terms of how risky you are, how much risk you have on the table right now. It's not a bad thing to have some bullish deltas, right? Bullish trades going. What is a bad thing is to be overloaded in that particular direction, considering what we're seeing on this, as well as some other charts we'll show in just a second. The other thing too that's really kind of standing out is that volatility index. I did mention on a tweet that in 2017 we also had a year like this year where we were below 85 for a good chunk of the year. Like we've been below 85 for a really, really good chunk of this year. Very similar to 2017. The difference is the VIX in 2017 was below 15 the entire year. This time the VIX is above 15 for most of the year. In fact, just barely got below 20 for this year. So it's a very different volatility index, and we see that as well in the skew. When you look at the skew indicator, look at the 20-day average for the skew is higher than it was when we peaked in 2018 going into a real bearish quarter, and the market was anticipating that kind of drop with the highest skew that we had in a while. So we've had an even higher skew now than we did there, and that's with our gamma exposure. It's interesting to see the gamma exposure just here on the 5th. So just last week, at 8.5 million, it looks low, and it is low. On a 6-month, it is lower, which is representative of how much call buying there is. But when you look at that 8.5 million, say compared to over here, the peak you had going into 2018 when things really hit the fan there, if you look at the top left corner on January the 11th, that was 8 million. So this figure right there, which doesn't look like a very significant peak at all, especially compared to recent levels, is still higher than that extreme high point that we had in 2018. So there's still a very, very high level of call buying going on, and that's keeping the put call ratio here in check. When you look at here, let's go S&P 500. And let's go out 5 years. When you look at the put-call ratio now being well below the mean over the last 5 years compared to where we were in 2018, it's extremely low, right? Like back there, we were one standard deviation down, and that kind of going into that crazy 2018 level, very, very low put-call ratio, extremely low. Well, now we've been actually trending higher, and we're still about as low now as we were then. And have been for most of this year below that one standard deviation. If you look at, if I were to change now, then you can see the put call ratio. You see how it's been trending higher while we've been getting to higher highs. The put call ratio has been getting to higher lows and higher peaks too. So there has been some more put buying going on. We see that in the volatility index as well. I've showed you this before, that trend higher. Now we did dip down, and that's where we see the VIX right now, just at extreme lows here, below 17, but well below 80%. So setting up for it, and really you see that in the volumes at 41 million and the trading range at 1.5 points. I mean, that's, those numbers are an extreme, like very low on the ATR, very, very low in the ATR, very low on the volume. We saw how low it was in the volatility index. We saw how low it was on these other. I mean, this extreme sentiment in terms of like complacency, but not in terms of like just this unbelievable risk-taking complacency. It's this kind of complacency where really nobody's doing much of anything except for buying extreme out of the money protection because of how extremely high the skew is, right? The skew is still remains extremely high. So the market is kind of dialing back its bullish risk and protecting against tail risk to the downside with these far out of the money puts that it's not necessarily doing, because you can see the VIX itself, the VIX ratio, is still really low. What that tells me is not only is the market looking at far out of the money puts for protection, but they're also looking at outdated puts, and not going 30 days out, but going 3 months out for that protection, by showing how cheap the VIX is relative to back there. So there's more demand for that 3 month right now than there is for the VIX, as we see with the put call ratio and all these other elements. So the market is not taking a lot of risk on from a bullish standpoint, as we're just grinding, but really preparing for big multi-month risk just in case. It's kind of what we've been talking about for the last however long, to ride the trend while we got it, and it's grinding. But when the market does exhale after an extremely long run, longer than normal, then the exhales tend to be longer too, and that's my expectations. I expect that we'll continue to remain bullish with small, just boring moves to the upside. Not a lot to make from a directional standpoint, plenty to make from a non-directional standpoint, but at some point in time, when we do get that unexpected exhale that comes out of nowhere, it will catch a lot of people by surprise. We talk in our classes about a catalyst that will spark, because it's hard to break a trend, a strong trend, as you can see on the trend strength indicator, without a catalyst. We're well above 5, we're well above 80. You can't break that without some kind of catalyst. And the market, and we might say, well, this can be a catalyst or that can be a catalyst. A catalyst isn't expected. So a catalyst is something that the market hasn't already thought about or priced in. Otherwise, they would already be breaking that trend and pricing in that catalyst. But so it's going to come out of somewhere and nowhere, and the market's not going to expect it, and that's what's going to spark that bigger than expected exhale because of how long we've been quote unquote holding our breath. Does that that happen this week? Who knows? Doubtful, right? Because again, it takes time, but as it does take time, it will come out of nowhere. It'll be some unexpected announcement. It might be here. It might be fiscal related. It might be foreign. It might come out of China again, like it did in early 2018. That kind of sparked that run after a big, long 2017 of very low volatility. We finally had something come out of China, and that sparked a year's worth of volatility going through 2018 into 2019. About a year and a half's worth of volatility after we had that catalyst there, coming again after an extremely long impulse move. So what do you think? Do you agree with that? Do you disagree with that? Let me know down there in the comment section below, especially if you disagree. Let me know if that is something, what chart or indicator you're looking at that suggests why either, again, you're a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another video again tomorrow. It's a quick way to give us feedback. If you like our videos, of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do and you want to let us know, it's really easy. You can do it right now while you're watching by clicking that thumbs up icon. That goes a long way for us. So we appreciate those who do that. Also, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe for free to our site. You do get a unique offer to check us out for our free subscribers, so subscribe there to check out that offer. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right. This is the Market Outlook live video. I do this every day. I do the Market Outlook. Obviously not today because I just barely got back in town. But I do review all the trades I've done previously in other Market Outlooks. We continue to manage them and watch them until we get out of them. Which is just as important to know, right? Is when to get out of these, is when to get in. So check that out there. You can also see all the upcoming trading rooms down here on the bottom. Again, all of our paid subscribers get access to those. Those things I just talked about there. Our premium subscribers get access to all of that for less money per month. In addition to that, they also get access to our class forums for each one, as well as our premium resources. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also hit this thumbs up icon. It opens up another new tab. Hit that like button as well. Again, we appreciate those who do that. Again, our content gets out to more people. The more people that will like our content because of the engagements, it gets out to people who actually follow our accounts. You can see there's a lot more than 71 people who follow my Facebook page, yet that's all who are able to see it. So that's why we keep asking for the engagements there to help get it out to more of our followers. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at how these different asset classes are performing these last couple of days. Like I said, since I left town on Thursday afternoon. So we're going to go to asset class comparison. And we're going to look at the last couple of days. So let's go to August. We'll start with the 6th and go through the weekend into today. So you notice the dollar has had a big jump along with small caps on Friday, and it held most of those gains today. Small caps obviously didn't. You can see the big strength in gold. Look at the dollar. Look at what it's doing to bonds, commodities, and gold. Commodities today really getting hammered. Gold really getting hammered, though gold got hammered on Friday too, and then you can see long-term bonds really struggling the last couple of days and dropping like a rock, which means yields are rising again. You can see the pressure on the risk appetite, right? Is really IWM is the only asset class that was positive along with the S&P. Everything else was, even bonds, foreign bonds, obviously long-term bonds, the Qs, all international stocks, real estate, all down. It's that strength in the dollar putting pressure on things. So let's take a look at the Euro US dollar and see that move that happened on Friday and then the follow through today, getting down to these levels again. We talked about that possibility. This cluster is for the period that's just barely starting just a couple of hours ago, so we'll see if that ends up staying there. But that's a pretty significant breakdown yesterday. Last time we broke down it below the 78% level, it didn't hold, right? We went right back up a couple of days later and then tried to break down again and got right back up. So it didn't hold that breakdown. You remember, this is the move, this bullish move right there the end of last year is what we've been retracing. And we've tried to get out of that bullish move, but we were unable to get out of that above the 23 or below the 78 and hold those. And right now we're trying again below the 78. So it's really important to see whether or not we actually break down, but obviously strongly bearish right now. The intermediate line easily back down below 40 and has been for a while here. So we are in, a bullish trend for the dollar, bearish trend for the Euro US dollar. You can see the big bearishness that we've been getting in long-term bonds. Now, you notice here that, again, kind of the same thing we've talked about before. When you break the 17-day moving average and then the 30-day on successive days instead of all in one day, then that tends to end up being a bounce signal. So I wouldn't be surprised if long-term bonds really bounced off of this extremely low bearish sentiment and we turn back up again here. Now, we are, we've had a pretty good intermediate run, so this might be the beginnings of an intermediate pullback. I actually do think we'll probably still converge a little bit and maybe even get up to a slightly higher high and diverge potentially with what we're seeing there. You can, again, see that on the MACD where, again, this is breaking just a little bit below the 30 and doing it the day after breaking the 17 usually leads to a bounce. Of course, doesn't mean that it has to be, and we can easily continue to fall down there. You can see from a directional movement index that bearish move didn't really start a bear. The bearish index has been higher, right? It got higher over here on that drop. The bullish index has not even dropped below 25, so it's flirting, but you can see that we're hardly starting a bearish directional move here on long-term bonds, or for that matter, on the 10-year yield, right, which has been so bearish. I think we're, same thing. We're kind of getting to a bearish. This is more of a bearish signal, sell the rip kind of a move than it is a bullish signal. So keep that in mind. What really is standing out to me in terms of bearishness is commodities. Commodities are breaking down, commodity basket as a whole. But if you look at crude oil, we are in a bearish intermediate pullback. Dark pink shading, red line. We are below 40 in the intermediate line. We had an intermediate pullback slightly over here. We had one over there in September. It's kind of hard, and over here we had the Nasdaq in pullback mode. It's hard for for crude oil, especially, to be in its own intermediate pullback without equities following suit in terms of risk appetite as a whole. So I think what we're seeing here is, crude oil especially kind of telling us that risk appetite has definitely been waning and now is moving in the other direction. You can see from a trend strength standpoint, we are above 65. We are below -2. So we are below the Ichimoku cloud. So we haven't seen that before. So we are in bearish mode, bearish pullback mode on crude oil. That is something that you normally don't see, again, without equities themselves also being in bearish mode. You can see the lower quartile pushing down here. You can see also from the RSI and CCI being in bearish territory on both those levels. The directional movement index showing a directional breakout move below 20 on the positive, above 30 on the negative. See, that's a bearish move that we're not getting on on the yields. Oh, no, on TLT, right? That's not necessarily a bearish breakout directional move. So risk as a whole, the Russell has been, the commodities now showing, especially crude oil showing, and the dollar really being bullish, shows us that the risk of appetite trades definitely not as strong as it has been, is definitely on the wane, and the risk aversion trade across multiple asset classes is just growing and getting stronger, as we saw with the move with the dollar. Right, it's a risk aversion trade that just continues and continues to get very, very strong. Now let's take a look at how that's shown over, at least obviously from a sector standpoint. We're not seeing it yet with technology rolling over, but you can see how it's been kind of stalling now. And if you take a look again, just the last couple of days where the dollar made that tremendous move and put a lot of pressure on risk assets. Financials have benefited from the rise in yields. Materials have benefited from being an oversold condition. They have been oversold. But look at everything else. Energy is down. Real estate's down. That's been a strong sector. Discretionary technology is down. Communication services are down. Industrials have been bullish. See, all these on Friday, the small cap type sectors, financials, materials, industrials, energy had all been bullish, but obviously today not so much. So if you look at just today alone, healthcare and staples are up, which are safety areas. Financials are up because of the rise in yields, but everything else cyclical is down. So again, even from a sector standpoint, we're seeing a waning of risk appetite. Convergence, I guess, would be a good way of saying, of risk appetite, and an increase in risk aversion. You can see financials kind of a big. But I really, again, if yields are showing that bearish pattern and short term bearish pattern, and bonds are showing long-term, showing a short-term bullish pattern, then you would expect that bounce that we've had here to come back to where some of these other areas are that did not get that quite that significant of a breakout. You can see industrials is flat, and materials is flat, and energy is flat, and financials is not because of that breakout. And I assume that would be more on the fake out side, and we'll come right back down into this area where everything else is. And you can see the convergence continuing on XLK, XLY, and XLC, and the strength that we're still seeing in healthcare and staples and utilities and real estate converging as well. But you know, the strength that we're seeing in the safety areas as we're getting more and more of a move towards those areas. Here, let's go sectors ETF, and then let's go to daily. You can see the cyclical area: industrials, materials, financials, energy, all moving down to the left. XLC is also moving down to the left. XLY is moving up to the right with XLK on the weekly chart. But then you look at the daily chart and you can see financials, materials, energy kind of trying to think about what it's doing. But you can see XLK is moving down to the left. XLY is moving down to the left. XLC is moving down to the left. XLI. And really the only thing holding up besides materials and financials and energy, which had some strong momentum off of oversold levels, is utilities and healthcare. So, you know, we're seeing a rotation into, and here's the 10 days. You're seeing the rotation here into, let's go to, into these safety areas away from the cyclical areas. All right, that brings us to our trade idea of the day, and one of the stock I want to look at that looks like it might be kind of reversing its own intermediate pullback has been Mosaic. Mosaic has been on a drop since June. It had multiple clusters here. It's gone through earnings. It's shifted to dark green shading the green line, breaking out today above a lot of different highs. In fact, it's the highest close that we've had for weeks, and really the only high was at that kind of little sore thumb that's sticking out there. Is the only one we didn't close above in this almost 2 expiration cycles. So a pretty decent bullish move. You can see what the pullback looks like on this chart. We had pulled back below the 50-day moving average. We have flipped from being a bearish trend to some transition candles, and now the bullish candle this week. If you look at the 3 green arrows, obviously you have 3 green arrows and a jump in volume, a little bit above average volume, which is unique for Mosaic because nothing's got very much volume today. It's been so extremely low. The MACD has turned positive. We have a positive divergence going on with the 8 and 17-day moving up away from the moving average. If you take a look at the RSI and the CCI, you can see breaking through 50, getting up towards 60, getting up towards 200. We haven't seen that for a while in either one of these indicators. From a directional movement index, you can see the breakout signal here above 25, below 20 or almost below 20 there. So again, we haven't seen it get above 25 except for one brief little turn there, but the negative was just barely below 25 then, and now it's almost below 20. If you take a look at the trend strength indicator, you can see how bearish we had been. Obviously not bearish anymore and working our way back up into the cloud. So, you know, again, not as strongly bullish, but there's ways that we can trade stocks that we're bullish on but not as strongly bullish. Even though if we're breaking, pushing up against that upper Bollinger Band with a very low bandwidth, and also breaking out above this volume node and the top of the value area there. So a nice little move higher. You can see from a Keltner standpoint too, you're breaking up above the upper band and not quite above the upper Keltner channel yet, but you can see how we're kind of working our way there with some positive momentum building. So, and then like I said on the market forecast, the intermediate line breaking up, not breaking above 80, but breaking above 60 when it had kind of paused there with a good strong near-term run. So, you know, good opportunity for Mosaic. Obviously, we have some support now down below us because of that volume node. So that sets us up for doing a bull put spread where I can sell the 31 strike, buy the 29 strike, try to get at least 47 cents out of it. We're through earnings, so I don't have to worry about smaller position size than normal, so we can go for a normal reward for the risk that we're taking. You can see where I put that slice, the break even, and set that onto the chart for September. So that puts our, here, let me do this one more time, but we'll do it on the Bollinger Bands, and we'll go Mosaic here. So let's do this one more time. Let's remove that drawing and remove this one too. So let me set that slice one more time to the chart, and you can see right below that volume node. So it'd have to really significantly break through support for us to get out and kind of undo this little breakout that's having right now that we're starting off with. So not a strongly bullish trend. You can see it's only, when you look at the deltas, it's only a small positive delta, especially when you beta weight this. If I were to beta weight it to SPY and just look at Mosaic alone, you can see it's only a 14 SPY deltas, so it's not very much at all, but it is positive theta. Gives me a little bit of negative Vegas as well, so it gives me a small positive bullish trade. Again, not strong, but positive theta too, and so that's really the kind of trades we want right now. It's going to be hard to be too directionally bullish, but this gives us something that we can be bullish with. You know, with some positive theta in case we just grind it. See, this doesn't have to go up. It just has to stay up above that $31 strike, which happens to be the volume node here. It has to stay up above that level for us to make what we expect that we'll make on this. Here's what it looks like on the 4-week short-term chart and where that break even is. Essentially, we'd have to break back down after getting a new 4-week high point, which is very positive. It'd have to break back down into the lower half of the chart through the point of control in the past 4 weeks. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. All of our subscribers, even our free subscribers, have access to that forum. So let's keep this conversation going. Open up any new threads with any questions or comments you have. Reply to other people's threads. And let's keep this going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, as well as like us on Twitter and Facebook. Subscribe to our site for free too. Follow us on Twitter. Have a great, comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.